The number Congress debated was $700 billion.
Today, I'm going to cast a red, white, and blue collar vote with my hand over my heart for this country because things are really bad and we don't have any choice.
That is the number that made the news. That is the number that produced the outrage.
The fact that you, Mr. Paulson, took it upon yourself to absolutely ignore the authority and the direction that this Congress had given you just amazes me.
The town halls, the phone calls to representatives.
Our economy is not stable. Working families are suffering. Unemployment is over 10% in my own district.
The famous moment when the House of Representatives voted it down the first time and the stock market dropped 778 points in a single afternoon. $700 billion. The actual number, the full federal commitment across emergency loans, equity stakes, asset guarantees, and credit facilities peaked at approximately $7.77 trillion. That figure was not disclosed voluntarily. It was hidden for 3 years until a news organization sued the Federal Reserve under the Freedom of Information Act and won. When the Fed finally released the records, Bloomberg News spent months reconstructing what had actually moved, to whom, and under what terms. The gap between $700 billion and $7.77 trillion is not a rounding error. It is a choice about what the public was allowed to know. But the dollar figure is not the most instructive thing the paper trail shows. What the paper trail shows in SEC filings, Federal Reserve records, congressional testimony, SIGTARP audit reports, and documents released under FOIA litigation is something more specific than a number. It shows a shape. The rescue had a shape. Particular institutions received particular terms. Particular people designed those terms. And the distance between the people who made the decisions and the institutions that benefited from them was, in several documented cases, very short. This is not the story of the 2008 financial crisis. You already know that story. This is the story of 9 specific institutions, the specific decisions that kept them alive, and the documented relationships that surrounded those decisions. The paper trail survived. Here is what it shows.
If Bear Stearns, I think the Fed did the right thing by stepping in on Bear Stearns. If Bear Stearns had failed on Sunday night, and it would have, they would have walked over to a federal judge and handed him a bankruptcy.
Bear Stearns, the first rescue, the first conflict. Monday, March 10, 2008. Bear Stearns holds approximately $18 billion in cash reserves. It is one of the largest investment banks in the world. By Thursday, March 13th, that figure has fallen to approximately $2 billion. The institution is functionally insolvent. Not in a quarter, not in a month, in 96 hours. Word had spread through the market that Bear was in trouble. Counterparties, the firms that do business with Bear every day, lending money, settling trades, maintaining positions, began pulling their funds. Each withdrawal made the next one more likely. This is what a bank run looks like when it happens at the institutional level rather than the retail one. No lines around the block, just wire transfers moving in one direction very fast until the number approaches zero. The Federal Reserve Bank of New York, under its president, Timothy Geithner, moved to stop it. The mechanism was a $29 billion non-recourse loan, meaning the government bore the downside risk on Bear's most toxic assets, not the institution acquiring them. JP Morgan Chase agreed to purchase Bear Stearns for $2 per share. 1 year earlier, the stock had traded at $172. Under shareholder pressure, the price was later raised to $10. The $29 billion in federal support remained. The terms of that support deserve a moment. A non-recourse loan in this context works roughly like this. Imagine a bank agrees to buy a house that might be worth $300,000 or might be worth nothing depending on what's found in the basement. The government agrees to absorb any losses below $300,000. The bank gets the house. If the basement is fine, the bank profits. If the basement is a disaster, the government pays for the cleanup. JP Morgan got the house. The federal government took the basement. Now, the Federal Reserve Bank of New York is not a government agency in a conventional sense. It is a quasi-public institution whose board of directors includes representatives from the private banking sector. Class A directors are elected by member banks. They represent the banking industry's interests. On that board, during the period when the Bear Stearns rescue was being structured, sat Jamie Dimon, the CEO of J.P. Morgan Chase. The institution whose CEO held a seat on the board of the institution designing the rescue was the same institution that acquired the rescued firm under the most favorable terms the federal government had ever extended to a private acquirer. Dimon recused himself from specific votes. The precise boundaries of that recusal, what he participated in, what he stepped away from, have never been made public. The Bear Stearns rescue was completed on March 16, 2008. It established two things that would govern the next 7 months: that the federal government would intervene to prevent the failure of a major financial institution, and that the terms of that intervention would be designed by people with documented relationships to the institutions benefiting from them. Both of those things would become more documented, not less, as the crisis deepened. September 16, 2008, the day after Lehman Brothers files for bankruptcy, the Federal Reserve Bank of New York extends an $85 billion emergency credit facility to the American International Group.
Help is on the way for AIG. The government has agreed to provide an $85 billion emergency loan to help rescue the insurance giant.
AIG is not a bank. It is an insurance company, the largest in the world. And the reason it requires $85 billion from the federal government has nothing to do with insurance in the traditional sense. It has to do with a product called a credit default swap. A credit default swap is, in plain language, insurance against a financial loss. Except it is not regulated like insurance, does not require the reserves that insurance requires, and can be sold in quantities that bear no relationship to the underlying risk being insured. AIG had sold approximately $79 billion worth of these instruments against losses on mortgage-backed securities held by major financial institutions around the world. When those securities collapsed, AIG owed money it did not have to institutions it could not pay for losses it had guaranteed without ever holding the reserves to cover them. Think of it this way. Imagine a contractor who agrees to guarantee the work of 100 different builders, promises to pay for any defects that appear, but never actually sets aside any money to cover those guarantees. For years, nothing goes wrong, and the contractor collects fees for every guarantee written. Then one day, defects appear everywhere simultaneously, and every builder calls in the guarantee at once. That contractor does not have the money. That was AIG in September 2008. The government's rescue of AIG did not simply stabilize the company. It honored every one of AIG's outstanding credit default swap contracts at full face value, 100 cents on the dollar. No haircuts, the term for negotiated reductions in what a creditor receives. No negotiation. A private counterparty in the same position, attempting to settle the same obligations, would have negotiated. The counterparties might have received 70 cents, or 60, or 50. The federal government paid them in full. Which institutions received that money? For 4 months, the public was not told. The Federal Reserve Bank of New York, the same institution that had structured the Bear Stearns rescue under the same president, instructed AIG to redact the names of counterparty institutions in an SEC filing in November 2008. The names were removed. The filing was submitted without them. When those names were finally disclosed under congressional pressure in March 2009, the list looked like this: Goldman Sachs, $12.9 billion. Deutsche Bank, approximately $11.8 billion. Société Générale, approximately $11 billion. Merrill Lynch, $6.8 billion. By the time the full federal commitment to AIG was tallied across the initial credit facility, subsequent equity purchases, and TARP allocations, the number reached $182 billion. Neil Barofsky, the Special Inspector General for TARP, testified before Congress that the New York Fed's handling of the counterparty disclosure was not consistent with the transparency the situation required. The largest single recipient of AIG counterparty payments, $12.9 billion, was Goldman Sachs. The Treasury Secretary who oversaw the rescue was Henry Paulson. Henry Paulson had spent 32 years at Goldman Sachs. He had been its CEO and chairman. He had an ethics waiver that permitted him to participate in matters involving Goldman under certain conditions. He needed it. In September 2008, while the American financial system was in the process of coming apart, Treasury Secretary Henry Paulson and Goldman Sachs CEO Lloyd Blankfein spoke by phone approximately 24 times. This is documented. The New York Times reported it in 2009. The Financial Crisis Inquiry Commission referenced it in its final report. The frequency is confirmed. The content of those calls is not in the public record. What is in the public record is everything else. Paulson spent 32 years at Goldman Sachs before becoming Treasury Secretary in 2006. Upon taking the position, he divested his Goldman shares under a provision of federal tax law, Section 1043 of the Internal Revenue Code, that allows senior government officials to defer capital gains taxes when they sell assets to comply with ethics requirements. The shares were worth approximately $485 million at the time of divestiture. The estimated tax deferral benefit to Paulson personally was between $50 and $100 million. This is legal. It is designed to make it financially practical for wealthy executives to enter public service without facing immediate tax consequences on forced asset sales. The same provision has been used by executives from every industry who have moved into senior government roles. It is documented, disclosed, and unremarkable as a matter of tax law. What makes the arithmetic remarkable is what happened next. Goldman Sachs received $10 billion in TARP funds in October 2008. It received $12.9 billion through the AIG counterparty payments in the same period. It accessed Federal Reserve emergency facilities whose full extent was not publicly known until Bloomberg's FOIA litigation forced disclosure in 2011. On September 21, 2008, Goldman applied to the Federal Reserve to convert from an investment bank to a bank holding company, a regulatory change that unlocked those emergency Fed facilities. The Federal Reserve approved the application in one business day, processes that typically take months. Goldman repaid its $10 billion in TARP funds in June 2009 with dividends, which satisfied the government's requirements and simultaneously freed Goldman from the executive compensation restrictions that came with the program. In 2009, Goldman Sachs reported its most profitable year on record, the year after the rescue. The Senate Permanent Subcommittee on Investigations, in a 635-page report published in April 2011, documented that Goldman had simultaneously sold mortgage-backed securities to clients while maintaining a significant short position against those same securities, betting against the product it was selling. The net short position reached approximately $13.9 billion at certain points in 2007. The report found the practice troubling. The Justice Department did not bring criminal charges against any Goldman employee in connection with it. The SEC settled with Goldman in 2010 for $550 million related to a synthetic CDO Goldman had marketed without disclosing that a hedge fund betting against it had helped design it. Goldman neither admitted nor denied the findings. $550 million is a significant sum. It is also approximately what Goldman earned in 11 days of normal operations. In the third week of September 2008, John Mack, the CEO of Morgan Stanley, was making phone calls to foreign sovereign wealth funds and institutional investors asking for emergency capital investment. He later described the period as existential. Short sellers were targeting the firm. Liquidity was disappearing. The institution that had survived the Great Depression, multiple market crashes, and the dot-com collapse was, by Mac's own account, days from the end. On September 29, Mitsubishi UFJ Financial Group wired $9 billion to Morgan Stanley to stabilize its capital position. The transaction was so large and so urgent that when normal wire transfer systems proved too slow, a physical check for $9 billion was delivered as a temporary measure while the wire cleared. A human being carried a check for $9 billion. On September 21, 8 days earlier, Morgan Stanley had applied to the Federal Reserve to convert from an investment bank to a bank holding company. The same conversion Goldman Sachs applied for on the same day. The Federal Reserve approved both applications simultaneously in one business day. Morgan Stanley received $10 billion in TARP funds. It accessed Federal Reserve emergency lending facilities available only to bank holding companies. Two institutions, one application date, one business day for approval. The Federal Reserve's emergency authority permitted this. No provision of that authority required the standard approval timeline to be observed. No public explanation was given for why it wasn't. The door opened in a day for both of them, and then it closed again. The weekend of September 13th and 14th, 2008, the same weekend Lehman Brothers was filing for bankruptcy, Bank of America CEO Levis Lewis agreed to acquire Merrill Lynch for approximately $50 billion, $29 per share. Merrill had been trading above $90 per share in early 2007. The deal made a certain kind of sense. Merrill's retail brokerage network, the Thundering Herd, 15,000 financial advisors managing client accounts across the country, was a genuine strategic asset. The price reflected Merrill's distress. Lewis believed he understood what he was buying. By December 2008, he understood it better. Merrill's losses, as they came into full view after the acquisition agreement was signed, were substantially worse than what had been disclosed during negotiations. Lewis contacted Treasury Secretary Paulson and Federal Reserve Chairman Ben Bernanke and indicated he was considering invoking the material adverse clause in the acquisition agreement, a standard contractual provision that would have allowed Bank of America to walk away from the deal. What followed is documented in congressional testimony, in correspondence released to Congress, and in the findings of the New York Attorney General's investigation. Both Paulson and Bernanke acknowledged the substance of what was communicated to Lewis, that invoking the MAC clause would be a mistake, that the government would reconsider Bank of America's own access to federal support if Lewis chose to exit. Lewis did not exit. He completed the acquisition. In December 2008, before the deal officially closed in January 2009, and before the public had any clear picture of Merrill's full losses, Merrill Lynch paid out approximately $3.6 billion in employee bonuses. The payments were accelerated. The losses being accumulated at the firm during the same period were approximately $27 billion. $3.6 billion in bonuses before the acquisition closed, before the public knew, after losses of $27 billion. The payments were legal. The New York Attorney General investigated. Bank of America eventually paid $150 million to settle securities fraud charges related to the acquisition and the non-disclosure of Merrill's losses. Ken Lewis stepped down as CEO in December 2009. He was not criminally charged. Bank of America entered 2008 as one of the largest financial institutions in the world. It exited 2008 having completed an acquisition it had been told by its government not to abandon, and having required approximately $163 billion in federal support to survive the consequences. The anatomy of that support: $25 billion in TARP funds in October 2008, an additional $20 billion in January 2009, specifically because of Merrill Lynch's losses, a government guarantee on approximately $118 billion in troubled assets. Together, those commitments represent one of the largest individual federal rescues of the entire crisis. The government's position, articulated by Paulson and Bernanke in congressional testimony, was that the Bank of America's failure in the aftermath of the Merrill acquisition and amid the broader systemic panic would have been catastrophic, that the $163 billion was necessary, that the alternative was worse. That may be true. What is also true and documented is that the sequence runs in a specific direction. The government pressured Bank of America to complete an acquisition. The acquisition produced losses the institution could not absorb. The government then spent $163 billion managing the consequences of the pressure it had applied. The paper trail does not resolve whether the rescue saved the financial system or whether it cleaned up a mess the government had a hand in making. Both things appear in the record. The record does not edit itself for clarity. Bank of America repaid its TARP funds in December 2009. The asset guarantee was unwound. The institution survived. Its shareholders absorbed years of losses and litigation costs. The people who made the decisions that produced those costs, on all sides, moved on. September 29, 2008. The FDIC, under Chair Sheila Bair, brokers a deal. Citigroup will acquire Wachovia's banking operations for approximately $2.1 billion. The FDIC agrees to absorb losses above $42 billion. Wachovia's depositors are protected. Its shareholders are largely wiped out. The deal is announced. The terms are set. 4 days later, the deal is obsolete. On October 3rd, Wells Fargo makes a competing offer, $15.1 billion for all of Wachovia with no government assistance required, no FDIC loss absorption, no federal backstop. 7 times Citigroup's price for the entire institution, in cash, with the government standing aside entirely. Citigroup sues. The Wells Fargo deal proceeds anyway. Citigroup eventually settles. The question the standard account never quite answers is what changed in 4 days. Why did the economics of acquiring Wachovia, an institution full of deteriorating mortgage assets, suddenly work for Wells Fargo when they had not worked 4 days earlier? Here is what changed. On September 30th, 2008, 1 day after the Citigroup Wachovia deal was announced and 3 days before Wells Fargo's competing bid, the IRS issued Notice 2008-83. The notice changed the tax rules governing acquisitions of banks with large loan losses. Under the new provision, a company acquiring a bank with significant losses could apply those losses against its own future taxable income, dramatically improving the financial economics of absorbing a bank full of bad assets. The notice was issued without the standard notice and comment rulemaking process, the procedure by which proposed regulatory changes are published, public responses are solicited, and the final rule is justified in light of those responses. It arrived fully formed, without public input, 1 day after its primary competitor's deal had been announced. Sheila Bair, the FDIC chair who had brokered the Citigroup deal and watched it evaporate, later wrote critically about the notice's timing and authority. Multiple tax law experts raised similar concerns. The IRS eventually acknowledged the notice had been issued without proper legal authority. Wells Fargo kept the benefit. The Wachovia acquisition proceeded. The tax savings ran to hundreds of millions of dollars. The explanation for the timing of Notice 2008-83 has never been officially given. Dick Kovacevich was not a man who chose his words carelessly. The CEO of Wells Fargo had built a reputation for plain speech about his institution's finances. When federal regulators proposed stress testing major banks in early 2008, Kovacevich publicly described the process as, and this is a direct quote from a speech he gave at Stanford, asinine. He said Wells Fargo was in strong financial shape and did not need government assistance. Based on available evidence about Wells Fargo's relative position among major American banks in 2008, he was not wrong. He was also not given a choice. On October 13, 2008, 9 bank CEOs were summoned to the Treasury Department. They were shown term sheets, 1 page per institution, outlining the capital injection each bank would receive under the Troubled Asset Relief Program. The meeting lasted approximately 35 minutes. Paulson's position, as reconstructed from multiple first-person accounts and subsequent congressional documentation, was direct. Every major institution would participate. Participation was not framed as optional. The reasoning was not irrational. If only visibly distressed banks accepted TARP money, the program would function as a public list of which institutions were dying. The stigma of participation would become a self-fulfilling prophecy. The banks that needed the capital most would be identified as the banks that needed the capital most, which would accelerate the runs that made the capital necessary. Making participation universal, or close to it, obscured the signal. Wells Fargo now appears twice in the documented rescue architecture. First, on September 30th, when an IRS notice changes the tax economics of acquiring a bank with large loan losses, 3 days before Wells Fargo makes a bid on exactly that kind of bank. Then, on October 13th, when its CEO accepts $25 billion in federal capital he had recently and publicly stated his institution did not need. Wells Fargo repaid the $25 billion in December 2009. It reported strong financial performance throughout the rescue period. Whether the money was necessary is a question Kovacevic answered one way in October 2008 and a different way in December 2009. Both answers are in the public record. The record does not reconcile them. Of every institution examined in this script, Citigroup received the largest documented federal commitment, $25 billion in TARP in October 2008, an additional $20 billion in November 2008, a government guarantee on approximately $301 billion in troubled assets, total federal exposure approximately $340 billion, not $340 billion spent, $340 billion committed, backstopped, guaranteed against loss. The distinction matters to the accountants. The scale matters to everyone. By the third week of November 2008, Citigroup's stock had fallen approximately 60% in a single week. The institution, the largest bank in the world by certain measures, with operations in more than 100 countries, was, by multiple contemporaneous accounts, days from having to halt operations. The government did not let it fail. No serious person in the room at the time argued that it should. To understand how Citigroup arrived at that moment requires going back 9 years. In 1998, Citicorp, a commercial bank, merged with Travelers Group, a financial conglomerate that included investment banking and insurance operations. The merger was at the time of announcement technically illegal. The Glass-Steagall Act of 1933 had separated commercial banking from investment banking precisely to prevent the kind of risk cross-contamination that the merger represented. The institution that became Citigroup was built in anticipation of a law that did not yet exist. That law arrived the following year. The Gramm-Leach-Bliley Act of 1999 repealed the relevant provisions of Glass-Steagall, allowing commercial banks, investment banks, and insurance companies to combine under a single holding company. Sandy Weill, the architect of Citigroup's creation, had lobbied for the legislation. Robert Rubin, serving as Treasury Secretary under President Clinton, had supported it from the Treasury Department. In 1999, Robert Rubin left the Treasury Department and joined Citigroup as a senior advisor and later board member. Over the following decade, he received approximately $126 billion in compensation from the institution. During that same decade, Citigroup used the freedoms created by Gramm-Leach-Bliley to accumulate the risk exposure that would nearly destroy it. The mortgage-backed securities, the off-balance sheet vehicles, the complex derivative positions that regulators did not fully understand and Citigroup's own risk managers did not fully control. In congressional testimony following the crisis, Rubin described his role at Citigroup as advisory and non-operational. He acknowledged that he had been aware of concerns raised about the company's risk profile. He said he had not believed those concerns would produce the outcome they produced. He said he had been surprised. The federal government was not in a position to be surprised. By November 2008, it had committed $340 billion to ensure that Citigroup's failure did not take the global financial system with it. Rubin left Citigroup in January 2009 as the rescue was being finalized. He was not charged, he was not fined, he was not required to return any portion of the $126 billion. The paper trail does not express surprise, it simply records what happened. The legislation was written, the institution was built, the risk accumulated, the money moved, the guarantees were extended, and the taxpayers stood behind $340 billion. And the man who helped write the rules that made it possible said he had not seen it coming. Every institution examined in this script survived. Their shareholders recovered, in most cases substantially. Their senior executives, with rare exceptions, faced no criminal consequences. The decision-makers who designed the rescue architecture, Paulson, Geithner, Bernanke, have written memoirs. In each memoir, the argument is the same. The alternative was worse. A complete systemic collapse, double-digit unemployment, a second Great Depression. That argument may be correct. The documented record does not settle it. Reasonable economists and financial historians dispute it still. What the documented record does settle is something narrower and more durable. The institutions that received the most favorable rescue terms had the deepest documented relationships with the people who designed those terms. The one-day approval that unlocked emergency lending for Goldman and Morgan Stanley, the counterparty payments at full face value that sent $12.9 billion to Goldman, while Paulson held an ethics waiver and spoke with Goldman's CEO 24 times in a single month, the $29 billion in federal protection that let JP Morgan buy Bear Stearns at a 98% discount while JP Morgan's CEO sat on the board of the institution that structured the deal, the IRS notice that arrived one day after a competitor's deal and 3 days before a competing bid, the $340 billion backstop for the institution whose deregulation was championed by the man who then collected $126 million from it while the risk accumulated. None of this required conspiracy. The relationships were legal, the waivers were documented, the board memberships were disclosed. The revolving door, from Treasury to Goldman, from Citi to the Treasury, and from the NY Fed to the Treasury and back again, is a feature of the system, not a malfunction of it. That is, depending on how you read the record, either the most reassuring thing about it or the least. The largest American banks are larger today than they were in 2008. The Dodd-Frank Act added constraints. Several of those constraints have since been modified. The revolving door between the regulatory agencies and the institutions they oversee remains open, as it has always remained open. The law does not require it to close. The paper trail documenting who walked through it, when, and what moved in the same direction shortly afterward, that paper trail is public. It has always been public, for anyone who wants to follow it.